Hi everyone, and thanks for joining us at Insider's Financing Net Zero virtual event. We've got a stellar trio of panelists here to discuss the tools that are funding ESG initiatives and help determine how investors are working to heighten their sustainable footprint. I've got Anne van Riel, the co-head of Sustainable Finance Capital Markets at BNP Paribas, Jennifer Wu, the global head of Sustainable Investing at J.P.Morgan Asset Management, and Kieran Donoghue, IDA Ireland's Global Head of Strategy, Public Policy and International Financial Services. Thanks everyone for participating in this discussion. Sustainable financing has become a hot button issue that's grown exponentially in recent years. Climate change, social justice and gender equality are front and center for governments, corporations and financial institutions which are investing billions in ESG initiatives. So with all that in mind, there's a plethora of funding structures to unpack. And perhaps, Anne, if I could throw it to you first, can you perhaps dissect what's worked in the financial markets so far?
You're right, the markets have grown exponentially. I think in the first 4 months, we have already surpassed the total volumes in the sustainable bond markets for 2019. So we keep on growing this market quite rapidly. Just to get some terminology out of the way, because we throw around a lot of acronyms and different terminology. Sustainable bond markets really mean all the ESG linked capital market debt products that there are. And in recent years, that has grown from more of the traditional green bonds, use of proceeds format, to a wider range of different types of bonds that are issued. Green bonds, social bonds, sustainability bonds, which is if there's a combination of green and social projects being funded. And in the last year, we've seen the rise of what we call the sustainability linked bond, which is yet another format where you don't have specific dedicated use of proceeds, but you have a normal bond, general corporate purposes, but a specific target linked to companies' environmental and social and governance metrics. And if you don't meet the target, there is a coupon step up or pricing increase. So those are a little bit the flavors. And we see that in the bond market, the public capital markets, but the same equally applies to the loan market, where we see similar structures as well.
Thanks, Anne. That's really helpful. I'd like to unpack some of those structures in the time we have today, but I do want to bring in Jennifer to the conversation as well. From the investor perspective, I mean, how are you sizing up these opportunities, Jennifer, when you look at your portfolio? And perhaps tell us the process of maybe scrutinizing the ESG worthiness in financing instruments.
I think, like Anne said, there is just a wide range of different types of instruments now that's available to us as investors. So I think as a start, we need to first understand what is it that we're trying to solve for, right? If what we're trying to solve for is to direct capital to a specific areas that requires green financing, then I think a very straightforward answer would be something like a green bond, right? Whereby the use of proceeds is very clearly defined. And also from a reporting standpoint, you could also really establish that link. Whereas if your purpose or intent is really to promote sustainability across the board, then I think a sustainability linked bond, i.e. there is no defined ways of how the proceeds are get used. That's probably a better way of allocating your capital, which is to really provide incentives for companies to do better from a increasing energy efficiency standpoint or gradually decarbonizing their business mix. So I think that's the starting point. That will also help to define what you do. The other point I would mention here is that there is actually very well established guidelines in the market. For example, if you think about ICMA, International Capital Market Associations, they've published guidelines on green bonds, social bonds, and so on and so forth. So I think for an investor who's only getting into the space for the start, these are some of the good sources that you could refer to help you understand whether some of these issuance or instruments are actually in line with what you expect them to be.
So while these developments in ESG are significant, there are still large swaths of the world that rely on fossil fuels. It's not something financiers and companies can just cancel out. So what is the business world doing to address transitional efforts to low carbon alternatives?
So firstly, many of our client companies have already publicly subscribed to net zero. So that's already part of their strategies. And as part of our conversations with them, we get a detailed sense of what their sustainability strategy is going to be, the time frame over which they're going to execute that. The vast majority of the companies and of the sectors in our portfolio are not from heavy carbon emitting industries. As a general rule, they tend to be low carbon emitting investors. Those that do emit carbon are part of the European Union emission trading scheme. So the vast majority of our clients have a good plan in place to progressively reduce their carbon footprint over time.
Can you talk to us about how financiers are helping that transition, or what are some of the sort of the headwinds as well in implementing transitional policies into economies and towards companies that have been traditionally, heavy carbon emitters?
Yeah, happy to comment. And traditionally, the green bond market was really to finance those what we call dark green projects like renewable energy and green buildings that would immediately have a positive impact on the environment, or at least not a negative. What I think the market and everybody has come to realize is that there's a number of high emitting industries where there's maybe no alternative yet in terms of technology that is low carbon, or at least transitioning to where we all want to go, the alignment to the Paris Agreement goals, and then we're really talking about industries that are essential to the economy, cement, for example, or steel making, where there's just no economically viable alternative yet for producing these products. And that's where transition financing comes in, and you have transition bonds that finance projects that are not green necessarily yet, but are on a pathway to get there. The sustainable linked loan or bond is also a format that addresses that issue. It's used primarily by companies that do not necessarily have the capex or the expenditures dedicated to green projects, but their overall business strategy is to reduce their energy consumption or their emissions. So there's different ways of addressing it. I think where we need to be very cognizant is that it is a product that is, there are guidelines around it as well. There's the transition guidelines by the ICMA. It's not meant to be used by any issuer that wants to do something but doesn't want to go the whole way there. So you have to have a very strong strategy on how to get there and how to get to lower emissions. So it's a difficult product. I will say it's easier to say, okay, we'll do a green bond for a renewable energy company than to come up with an issuance around transition.
Got it. Understood. That's interesting because, and the reason, one of the other parts I wanted to ask was, at the end of the day, banks, financial institutions are still providing financing in some instances to carbon emitting industries, right? I believe that there was an article I saw this morning regarding, the fact that banks do earn a lot of credibility and fees from green related financing, but they also earn a lot from heavy carbon emitting industries. So is there also a transition in place for the actual banks itself in the way they work with their clients?
Absolutely. I think there's a lot of plans in place, and as with anything, this doesn't happen overnight. Like the economy, banks finance the normal economy, and we also finance higher emitting industries where there's maybe no alternative. Many banks have zero new coal policies, like BNP is a very early adopter of that one. And banks have increasingly also come up with strategies and towards net zero or towards greenifying their balance sheet. So the principles for responsible banking is one such overarching community of banks, how to integrate ESG policies into the whole lending strategy. It's just not something that you can change rapidly overnight with big balance sheets at stake.
So, Kieran, perhaps from a public policy perspective, what is IDA Ireland undertaking to address the funding of ESG initiatives? And secondly, how are you and your team engaging with the financiers of the world?
So thanks, Aaron, for the question. So firstly, IDA Ireland, as you know, is a public body responsible for promoting Ireland for foreign direct investment. We manage a total client portfolio of approximately 1,600 firms. So we've just published a brand new strategy, and we've put sustainability right at the center of that strategy. So what that means in practice is that we're now reaching out to our multinational clients and having conversations with them around their sustainability agendas, with a view to financially supporting them to develop corporate climate action plans for their Irish sites. Secondly, we've also established a brand new green economy division within the organization that is now actively searching for sustainability investments on a global basis.
If I may, just pivoting away from the E in ESG, I mean, I think it's important to talk about the social and governance issues that are also part of financing. And perhaps, Jennifer, I'd like to get your point of view here. So how can you, from your seat, contribute to a greater adherence to social policies, whether it's justice related, whether it is gender equality? I mean, how does that impact your investment decisions?
Yeah, I think they are. That's a good question, because I think they're all interconnected, right? At the end of the day, if we want to make sure that we're investing in companies that are helping with transition to net zero, not only we want to make sure that they have the right technologies in place, but also we want to make sure that they have the right governance structure and the right people. So talent is really very important. So in my mind, you can't really have a good pathway to transition if you forget about the S and G, Aaron, to your point. But broader than that, I think, if we think about this in a more holistic way, what we want at the end of the day is what we call a inclusive and sustainable economy, right? And climate is a very big part of it, but so are the other components like societal, equality, justice, etc. So as part of our investment, I think this goes back to your earlier point. How could you help? How could we in the business world help to finance the transition? I think there's also another side of it, i.e. going beyond what's the use of proceeds. But when you invest either as a equity shareholder or a bondholder, you want to look at the issue or the companies itself. You want to look at the ESG credentials of the company, because that's the only way for you to ensure that however the money is going to get used will be used in the most appropriate way. So that's something that we do across our entire actively managed strategies, which is, really integrating the consideration of ESG. And so I think with that, you could really then think about, okay, do I then pivot part of the capital into areas which requires more adventurous financing or more higher risk financing, such as venture capital into carbon capture and storage for some of those sectors that are just harder to decarbonize. So I think, ESG needs to be at the foundation and integral to everything you do. And then on top of that, think about where you want to leaning a little bit more to gain exposure to specific opportunities to help with the transition.
What are these options, really simply put, beyond environmental linked financing options? I mean, what else can the financial world or financial markets do to promote social issues and governance issues as well?
If we stick with the topic of the sustainable bond markets, the inclusion of social categories in bonds has been growing in the past year, I would say. With when COVID hit, I think there was a big realization that specific minority groups or specific parts of the society were harder hit. So there's been a bigger focus by companies to provide more assistance or directed, targeted funding or assistance to these groups. And I'm not talking about charity, but more about training programs for women or minority groups. I think there's a bigger focus on making sure that the the representation of women and minority groups in leadership positions becomes more equal. I think we're very far behind on that in the US particularly, but it probably is equal in other parts of the world. So there is a bigger focus on it. I think more money will be directed at initiatives like that, and the social bonds or sustainability bonds can be a way of directing that money. Interestingly, I think there was a PE firm this week that announced the inclusion of a D&I target in a sustainability linked bond. So I think you will see more of that coming as well.
It is unfortunate that it takes human tragedy to kind of get the world to react in the way we kind of want it to be on the right side of history, which brings me to my next point. We can't talk about ESG and green related financing without addressing the subject of greenwashing, particularly in the capital markets and the public relations perspective. I mean, Kieran, I'd be interested to get your take from a public sector perspective. I mean, a lot of the skeptics might say that green financing or ESG initiatives could be nothing more than lip service. I mean, how do we prove them wrong, if you like, or how do you prove the naysayers wrong?
Firstly, when someone mentions greenwashing to us, we acknowledge that greenwashing is a risk. There is evidence that it has happened and continues to happen, in part because every business now wants to embrace the sustainability or climate action agenda. That said, we also recognize the interventions that policymakers and regulators have taken, which we believe will diminish the prospects of greenwashing over time. So an example of this would be the European Union's Sustainable Finance Disclosure Regulation, and also the taxonomy regulation that is being introduced in Europe. The introduction of classification of investment funds, etc. We think that will diminish the risk of greenwashing over time, and that right now we're on a much better path with respect to managing greenwashing in terms of the climate agenda discussion.
I agree with Kieran. I think policy and regulations are crucial at this juncture. And if you think about it, I think there's finally better appreciation of how if the companies themselves don't provide disclosure, or the disclosure on be it climate related data or other type of sustainability metrics are just not consistent and not standardized, it's very, very difficult for investors or financiers, if you like, to be able to judge whether this company or this issuer or this investment opportunity is really going to channel capital to where it needs to be. So I think regulations to make company disclosure on some of these sustainability related metrics is really crucial, right? Because I think standardization will help to create transparency and really level the playing field for everybody. And that's the only way that you could really help to further advance the transition, because otherwise it's going to be really hard if you don't have a transparent system in place such that retail investors, if you like, can compare one product to the other.
Excellent. And Anne, do you believe that the penalties that are, I guess, offered in these capital markets instruments, are they material enough?
I think we're at the start of the developments in this market on the sustainable linked bonds, and we'll see where it goes. But I think in the end, this is a public market instrument, and investors are increasingly very savvy on how to evaluate these and benchmark them. There will be increased scrutiny on the ambition level, on the selection of the KPIs, and what the consequences of not meeting them. So there will be a development, and whether that will be in terms of the structure that the coupon step up may be higher over time, or whether it will be because some bonds will just perform better than others, or have a larger uptake in the primary market and more interest from investors, we will see. But I think it's important to realize that a lot of this so far has come from voluntary guidelines, right? The investors and issuers have gotten to this point through voluntary guidelines, transparency, and disclosure. The EU taxonomy and increased regulation will speed that up and make this more ingrained in the financial markets. So I think that we'll see more innovation and changes to come with this in mind.
I know that BNP and some of your peers have completed transactions, sustainable transactions for companies that, as we mentioned earlier, may not necessarily be known as low carbon emitters. Could you talk us through how the structuring process is for a company that is a pulp and paper producer or a cement company, perhaps? How do you talk through a transition process with them compared to a green financing for a solar plant, for example?
Yeah, the discussion around those type of products is really about how do you set an ambition level on your reduction of your greenhouse gas emissions, for example, that is as much science-based aligned and as much supported by the available technology in a certain sector. And there is a lot of thought going into structuring them and making sure that we are not just throwing out a number and saying, this is sufficient. We look at available technology for certain production processes. We look at what peers are doing in the sector to benchmark, where they are at what level. We discuss science-based targets to make sure that we're aligned with, a 1.5 degree climate assessment. So it's not that easy for an issuer to come up with an ambitious target and to commit its financing to it. So that's very important to realize, right? It's a big exercise and a big commitment from a company to issue these instruments.
I want to understand, when you have these discussions from a public sector perspective, what are the biggest headwinds or roadblocks, if you like, when you speak to your peers and your clients about enhancing ESG related initiatives? I mean, what's the biggest sort of roadblock right now, if you had to summarize it?
I think it's been very well received. The vast majority of our clients already have quite sophisticated sustainability agendas, but they're anxious to identify opportunities to refine them and to improve them. For those clients that are a bit earlier in the sustainability journey, if I could call it that, they're really, really interested in having this conversation and understanding from best practice and from exemplars elsewhere within the portfolio, so they can learn from either their peers or from companies that are more advanced along the sustainability journey. There's also a recognition that climate risk now equals investment risk, and understandably, as professional investors, the vast majority of our clients want to take steps to protect their investments and their assets from the risk posed by global warming.
Got it. And just quickly, Jennifer, as well, I mean, when you have these discussions with potential clients or investments, what would you say is your first question to these people or to these entities when they come to the market or come to you with ESG initiatives or financing opportunities?
For me, the bottom line is there needs to be recognition that climate risk is investment risk. So it basically, for any companies that are looking for us to invest, or we engaging with companies we already invest in, it has to be part and parcel with everything that they do, be it from CapEx planning or just, managing their business on a daily basis, because there's real costs associated with not planning ahead for transition or other potential physical climate related risks. So I think for me, that is like first and foremost top of mind for almost all of our clients. And also, front and center in all of the conversations that we have with the companies that we invest in.
And Jennifer and Kieran, thank you all for highlighting some crucial points regarding sustainable finance. As you all alluded to, there's a ton of ways that financial markets can best serve ESG requirements, and there's evidently plenty of work to be done to heighten the industry, the transparency, accountability for corporations, governments, and financial institutions. Thanks.